Could you survive without a paycheck? Here's why disability insurance matters. What if an illness or injury stopped you from working tomorrow? Disability insurance may replace part of your income while you're unable to work. Short-term coverage usually lasts a few months, while long-term coverage may continue for years, depending on your policy. Compare own occupation and any occupation coverage, waiting periods, benefit periods, and monthly benefits before choosing a plan. Premiums depend on your age, health, occupation, and coverage amount. The right policy can help protect your income and your family's financial future. Follow for more simple insurance and money tips.
Okay, take a quick second and really think about this. If someone walked up to you right now and asked you to name your absolute most valuable financial asset, what would you say? For most of us, our minds instantly jump to the obvious stuff, right? You might be picturing your house, or maybe that growing retirement account you've been diligently feeding every month. Maybe it's a stock portfolio or a small business you've poured your heart into. I mean, it's a completely natural assumption to make. But what if I told you that for the vast majority of working professionals out there, those answers are actually completely wrong? Spoiler alert, it is not your house. It's not your 401k either. Your true greatest asset, by far, is your ability to wake up every single day, go to work, and earn an income. Seriously, just think about the math for a second. If you make $100,000 a year and you've got 30 years left until you retire, that is $3 million of future earnings. $3 million. That completely dwarfs the value of your car or your home. And yet, here's the crazy part. While we all happily insure our homes and our cars without even a second thought, we almost always leave our absolute biggest financial asset totally exposed. So today, we're going to fix that by focusing on exactly how you can protect your ability to earn a living. So, welcome to this explainer. I am so thrilled you're here today. Our goal for this session is simple, but it is incredibly powerful. We are going to demystify the complex and, let's be honest, kind of confusing world of disability coverage. Now, I know it's a topic a lot of people tend to shy away from because the insurance jargon just feels overwhelming. But I promise you, stick with me, and by the end of this, you are going to understand exactly how this stuff works and why it is absolutely critical for your financial foundation. All right, let's look at our roadmap for today. We'll start with the income safety net. Then we'll break down short versus long-term coverage. After that, we'll cover own versus any occupation, then group versus individual plans, and finally, we'll wrap up with the nitty-gritty costs, wait times, and taxes. Okay, Section 1, the income safety net, protecting your paycheck. Let's jump in. Before we get lost in the weeds of premium calculations and policy types, we need to get straight on what this insurance actually does for you on a day-to-day basis. At its core, disability insurance is simply a policy that replaces a chunk of your income, typically somewhere between 60 to 80% of your normal salary, if you get sick or if a physical or mental injury suddenly stops you from working. It basically acts as a direct, reliable substitute for your paycheck. As the source material points out, this is the money that pays your rent, buys your groceries, and just keeps the whole household financially stable. Most importantly, having this means you can focus 100% of your energy on just getting better, without that sheer terror of watching your life savings drain away in a single month. Moving right along to Section 2, short versus long-term, timeline of protection. Okay, so understanding the boundary between short and long-term protection is super important. It basically dictates how your safety net is going to deploy. Think of it as two distinct buckets. On the short-term side, you have your cushion for temporary setbacks. This coverage usually lasts anywhere from 3 months up to maybe 2 years, replacing roughly 50 to 70% of your salary. We're talking things like a severe bone fracture, a major surgery, or an illness you're expected to fully bounce back from. Now, on the long-term side, that protection is built for permanent or, highly prolonged conditions. Think major diagnoses like cancer, multiple sclerosis, or a permanent spinal injury. This coverage steps in for durations lasting from 2 years all the way up to your retirement age, or in some cases, your entire lifetime. And it generally covers a slightly higher amount, usually 60 to 80% of your salary. To really lock in this short-term concept, let's look at a super practical scenario straight from our sources. Meet Amit. He's a 35-year-old software engineer who accidentally fractured his leg, and his doctor straight up mandates 3 months of total bed rest. Thankfully, Amit has short-term disability insurance covering 60% of his salary. So, his policy kicks in after a very short waiting period, and he starts getting a steady monthly payout to cover his rent and bills while his leg heals. Then, boom, the moment he is fully recovered and back at his keyboard 3 months later, the benefits gracefully stop. It did exactly what it was supposed to do. It was the perfect temporary bridge. All right, Section 3, own versus any occupation, defining exactly what disabled means. Listen, if you take nothing else away from this explainer today, please remember this part. We have arrived at what is arguably the single most important provision in any disability contract. How the insurance company legally defines the word disability dictates whether you actually get paid or if your claim gets tossed out. Usually you're going to see two definitions. First is own occupation. This means the policy pays out as long as you are unable to perform the duties of your specific regular occupation at the time of the injury. It is highly robust and super flexible. On the flip side, you have any occupation. This one is way stricter. It only pays out if you are unable to work in any occupation that you're reasonably qualified for based on your education or experience. And the tricky part here, any occupation is very, very often the default standard if you're just relying on a basic group plan from your employer. Let me illustrate why this is such a massive deal with something called the surgeon's dilemma. Imagine a top-tier, highly skilled heart surgeon who tragically develops a permanent hand tremor. She can absolutely no longer perform those delicate surgeries, right? But because of her vast medical knowledge, she could easily take a job consulting or maybe teaching at a university. Now, if she has an own occupation policy, the insurance company pays out her full benefit because she can no longer be a surgeon. And, get this, she gets paid even if she takes that consulting job. But if she only has an any occupation policy, the insurer might literally look at her and say, well, you can still work as a medical consultant, so we aren't paying you a dime. I mean, wow, it is a completely night and day difference in protection. Moving to Section 4, Group versus Individual Plans. Essentially, where do you go to get this coverage? So, group disability is usually provided by your job. It covers all the eligible employees, and generally, you don't even need a medical exam to get it, which is awesome. But here is the big catch. If you leave that job or get laid off, the coverage ends. Poof, it does not travel with you. Now, individual disability is a private policy that you go out and buy on your own. Yes, it requires medical underwriting, meaning they are going to look at your health history, but it's guaranteed renewable. Now, what's really interesting here is the portability aspect. An individual plan follows you seamlessly from job to job. Plus, high earners frequently find that their employer's group plan caps out at a benefit limit that's way lower than their actual salary. So picking up an individual plan is just a brilliant way to supplement a capped employer plan and make sure your entire income is truly bulletproof. And finally, Section 5, Costs, Wait Times, and Taxes. We're diving into the fine print. We are officially peeling back the final layer of the onion here, the financial mechanics. Let's talk about premiums, waiting periods, and how the taxman is going to view your payout when you finally need it. First, let's demystify a bit of industry jargon you will see on absolutely every single policy, the elimination period. Honestly, just think of this as a time-based deductible. It is simply the waiting period, which can be anywhere from 30 days all the way up to 720 days, between the exact date your disability starts and the date the insurer actually begins writing you checks. During that elimination period, you are entirely responsible for your own living expenses out of your own pocket. So, what actually dictates how much this coverage is going to cost you every month? Well, your premium is impacted by a few core factors. First, your age and current health are huge. Buying a policy when you're young and healthy is significantly cheaper. Your occupation obviously matters too. A software engineer sitting at a desk is going to pay less than an offshore oil rig worker. High-risk hobbies? Yeah, if you love skydiving on the weekends, expect your costs to bump up. The total benefit amount and how long you want the payout to last play a big role as well. And lastly, that elimination period we just talked about. This is a big one. Picking a longer elimination period, say waiting 180 days instead of just 30 days, will drastically lower your monthly premium. But obviously, it requires you to have a much fatter emergency savings account to bridge that gap. To put some real-world perspective on this, premiums generally run somewhere between 1% and 4% of your annual income. As you can see from the source data, if you're making $100,000 a year, you can expect to pay somewhere between $83 and $333 a month, and that scales up or down depending on the exact coverage limits and waiting periods you choose. Basically, you're spending pennies to protect the dollar. It represents a tiny fraction of your income to protect the absolute entirety of it. But hold up, because there is a massive tax rule you absolutely must understand here. If your employer pays your premiums for a group plan using pre-tax dollars, which, yeah, gives them a nice upfront tax break, any resulting benefit payouts you receive during a disability are going to be fully taxable to you. That means that nice 60% income replacement is actually going to feel like a whole lot less once the government takes their cut. Conversely, if you pay your premiums yourself with after-tax dollars, which is how individual plans work, the resulting benefit payments are completely tax-free, no taxes owed. This dramatically changes your actual take-home amount during an emergency, so it's a critical distinction to know. Okay, let's say the worst actually happens. How do you get your money? Luckily, the claim process is a highly structured, straightforward 4-step procedure. Step 1, you inform the insurer immediately. Step 2, you submit all your required documents. We're talking medical diagnoses, notes from your doctor, and your employment records. Step 3, the formal claim process kicks off, and it usually takes about 30 days for the insurance company to verify everything. And finally, Step 4 is claim approval and payment. Once that elimination period is officially met, your structured payout begins. It's a formal process, for sure, but knowing these steps ahead of time really helps remove the panic from the situation. Just as a quick final note on customization, you can actually enhance these policies with optional add-ons, which the industry calls riders. For example, you might add a residual disability rider, which pays out a partial benefit if your illness means you can only work part-time. Or, and this one is a real game changer, a future purchase option rider. This lets you increase your coverage amount as your salary naturally grows over your career, and the best part, you never have to take another medical exam to get that higher coverage. So we've broken down the types, the strict definitions, the tax traps, and the true costs. But as we wrap up this explainer, I want to leave you with one final question to really bring all this source material home to your own life. Ask yourself honestly right now, if your paycheck completely stopped tomorrow, no warning, how many months could your emergency savings actually carry your family? Understanding the facts today proves that our ability to earn is our true golden goose. Don't let an unexpected medical emergency wipe out a decade of your hard work. Take a hard look at your employer benefits, assess your savings, and figure out exactly where your gaps are. Knowledge is power, but it only works if you act on it. Thank you so much for joining me on this explainer, and keep